All right, folks, we are coming to our final sessions of the day. Over in the parallel session in conference room 2, we have Mr. Ayman Shamsul, the Vice President of the Malaysian Association of Technical Analysts, who will be talking about momentum and building a portfolio from a technical approach. So if you're keen on that, do click on the conference room 2 button at the bottom of the screen and head over there right now. But over here in conference room 1, we will be talking about an investment sector that has probably suffered the most over the past 2 years. We're talking, of course, about the hospitality sector. And to help us understand whether it's due for a rebound and to help us also look at specific players in this sector, we're very glad to have with us the co-founder of Kaya Plus, Joo Parn, and Yanlin, who's a senior equity dealer from Phillip Securities. They'll be taking turns to offer their points of view before moving into a larger discussion. As always, you can enter your questions into the Slido box on the right. So, Yanlin, Joo Parn, is it time for us to pack our bags and go on holiday again?
Hi, Albert. Thanks for the introduction. And welcome everyone to the final session of the Singapore Trading Festival. So as Albert mentioned, we are seeing a change of tide when it comes to travel and also how things have actually migrated over the past 2 years, right? We have seen the stock market slump, it rebounded, but for some sectors, they actually felt left behind, and now with a little bit of surety and certainty, we are starting to see some kind of positive catalyst, which Edward has already mentioned, which is the hospitality sector. Of course, when you talk about hospitality sector and tourism, it's a very huge sector of itself, but we decided to focus more on hospitality REITs because there are many choices out there compared to if you just focus on the aviation business, you only have SIA and also SETS. But I think from a perspective, by looking into Singapore Hospitality Trust, you have different kinds of REITs out there who are very impacted, but looking to rebound on this positive news. So maybe the timing might be a little bit too late because with the latest announcements by the Singapore government, also Malaysia government, they have lifted the quarantine requirement for travelers coming in and out of the country. So maybe I'll pose the question to Yanlin. Is it a little bit too late for us to actually talk about this topic as of today, or do the hospitality trust that we are talking about today have more room and prospects ahead of them?
Hello, hi everyone. Thank you, Joo Parn. Hello, good afternoon to everyone. So thank you for taking time to join us today. So my name is Yanlin, senior equities dealer at Phillip Securities Global Market Desk. So just now, Joo Parn mentioned, is it too late for us to talk about this? I think it's never too late. Yeah, apparently the COVID has affected every sector across the global, and the hospitality industry is among the hardest hit. It's been 2 years. As we all know, Singapore Hospitality Trust have a rebound, but haven't reached the level before COVID. So there's still opportunity. So, and we do believe visitors' arrival and the hotel revenues will continue to increase as Singapore resume reopening international borders. So before we talk about the hospitality rebound, right? So we still must talk about the COVID situation.
Right.
Yeah, let's see. Okay, so just let's see some background and data first, and then.
Yeah. I'll start it off with a disclaimer. Of course, what we are sharing with you guys today in this sharing session is just purely for informational purposes. I would say that even though a lot of macro changes or border changes, the rules have changed during the preparation of this slide. I think this slide underwent a few iterations because we actually started on these slides when everything was very uncertain. There was no talk or even a little hint on how the border measurements were actually panned out. But over the years or over the months, things have started to smoothen out and loosen out. So I think it's a good way to actually go through what we actually prepared in terms to understand the so-called basis or thesis behind, right? Back then, everything was uncertain, and you have REITs or hospitality trusts that have operations around the world, different countries. You need to look at their different countries' border measures as well. So we also inputted that information as well. So it might be irrelevant now, right? But I think the picture we wanted to portray is that you need to actually have this kind of thesis, maybe in the next or future, use the same kind of framework to actually deduce your risk to reward, right? So of course, all the information we try to portray as best as possible by relevant sources, and of course, this does not construe you to buy, sell, or hold any investment securities or companies mentioned. So I'll pass it over to Yanlin to talk about COVID, or more likely the recent Omicron variant, which I think has terrorized countries around the world. What's the so-called definition, and what are the so-called professional views of it, and how has it affected the border measurements of each country?
Okay, thanks, Joo Parn. Thanks. Okay, so let's just look at some data and some background information first. So this is from CDC, the Center for Disease Control and Prevention. So CDC has been collaborating with Global Public Health to learn about Omicron. The Omicron variant spread more easily than earlier variant of the virus, and it causes symptoms similar to previous virus. However, it causes less severe disease. It usually just causes the more mild disease. So it means it is not that frightening, at least for the young generation. We don't need to be that afraid of the Omicron. Okay, so next slide. Yeah, this is the data from the MOH. So we can see that even though the numbers are not dropping, the COVID-19 vaccines continue to offer high levels of protection against severe disease, hospitalization, and death, especially for people who are boosted. So during the recent Omicron surge, people who were boosted were 21 times less likely to die from COVID compared to those who were not vaccinated. And it's 7 times less likely to be hospitalized. So we can see that actually, as long as you are vaccinated and boosted, so there is no need to be that worried about this. That's why we can see that more and more countries are open the borders now. Yeah, so next slide, please. Yeah, just because of this situation, we have been seeing more and more countries reopen to international travel, including the US, UK, Europe, Japan, Australia, and Singapore, and etc. And with the rollout of the vaccines and boosters, many countries are gradually relaxing travel restrictions as well. As we all know, recently the Singapore also further eased the traveling rules. So we can just see that as the more it is situation in Singapore, actually we don't need to be that worried about the Omicron spread. So next slide, please. Thank you. So this is the international arrival trend in second half year to 2021. So we can see that international arrivals have rebounded since the second quarter last year, in which actually the Europe recorded the strongest result, and the US was the next strongest. Next slide. Okay, so this is the Singapore further eased the COVID restriction at the end of last month. So 9 months after the Singapore government charted a roadmap toward living with the COVID-19, the biggest easing of restrictions announced by PM Lee, and no quarantine and no VTL flights are required. These simplified travel rules are generating real excitement in the air about the prospect of the hassle-free traveling once more. So as the world adopts an endemic stance with the rising vaccination rates, we are expecting to lead a steady increase in visitor arrivals in the coming months. Of course, the hospitality industry will benefit a lot from it. Okay, so next slide, please. Okay, so there are these are the hospitality trusts we will go through today. But before we talk about each individual stock, I think some people are still confused by the difference between the pure REITs and the business trust. So I think I just roughly go through some. Yeah. So as the picture shows here, the most apparent thing is the different management structure. A REIT involves two separate entities, the manager and the trustee. Managers run operation and provides management service, and trustee owns the asset and acts on behalf of REIT unit holder, while a business trust is managed by the same entity that owns the asset and managing them. The shareholders of REITs and the business trust all can get the distribution, but there are some difference in the policies regarding the level of the dividend. Like REITs are required to distribute at least 90% of their taxable income to the dividend. This ensures a regular stream of income for REITs investors. Conversely, business trusts do not have to have a minimum level of payout. Okay, so this is a rough difference. So next slide, please, Joo Parn. Yeah, as we can see here, of these 5, except for the OUE commercial REITs, all others are 100% exposed to the hospitality recovery catalyst by the revenue. So next slide. Okay, this slide shows the operating countries for each trust. The OUE and the Far East trust are only exposed to the Singapore market, while the rest of 3 are exposed to the global markets. And we apparently most of the global markets are open border now. So I think I will stop here first, Joo Parn, over to you for the fundamental part.
Right. Thank you, Yanlin, for bringing us through the macro part of it. And I think if you look back why there was a need to actually prepare the macro was now looking that everything has opened, the borders are open, and most of the REIT or hospitality prices have actually climbed back up. The best period was actually to buy them when things were a little bit uncertain back then, but knowing that the Omicron variant is not as severe as a Delta variant, and there are also a slight reopening in the local economy or the local consumption or support, where people are going on local staycations at the relevant or respectable hotels at their countries. So that already gives a good indication that if you want to punt or on hospitality trust rebound and recovery, that would probably be the golden period looking back from now. But moving forward, since now that everything has reopened, we try to look at things from another perspective. How far or how further can all these hospitality trusts climb? They are still, some of them, most of them are still far from their historical high pre-pandemic. So what are the so-called factors and what are the so-called concerns and questions you should ask before you choose one that suits your investment appetite and also risk as well. So we head on to the first candidate of today's sharing, OUE commercial REIT. We mentioned just now that this is, I would say, a REIT that not only has access or exposure to hospitality, but it also has exposure to the commercial segment as well, which is the offices part of it. So here you have a breakdown of the portfolio composition of OUE commercial trust. You can see that they do have a fair share of properties which are hotels, Mandarin Orchard now and Mandarin Gallery. Then there are also Crown Plaza Changi Airport. So these are the so-called properties that made up the hospitality part of it. There's also office buildings or commercial buildings, One Raffles Place, OUE Bayfront and Downtown. So if you look at the total portfolio contribution of just purely the hospitality, because if you want to look at OUE commercial REIT from just a hospitality play, it only contributes 27%. You have to be wary that even if hospitality were to rebound, how much will it impact or contribute to OUE's overall performances? You're just only betting on 27%. If you do see some catalyst or prospects on OUE, you also do need to consider the larger portion of it, which is the office portion, which is 59% roughly. So this is something you need to take note of. It is not a clear-cut part on a tourism-related recovery, but you have to take consideration of all the different kinds of properties listed or that OUE commercial REIT is currently holding on. So just a brief check on their latest second half 2021 financial performances. You can see that in terms of overall performances, year-on-year change, the revenue of the total OUE commercial REIT is still down, and then it's mainly due to a deconsolidation of OUE Bayfront's performances. So basically, they sold off 50% of the interest of OUE Bayfront to another party. So the revenue contribution from OUE Bayfront, which is one of the more significant properties, actually pulled down the total revenue, right? And then on top of that, there's also a little bit of a drawdown of the income support by OUE downtown offices, meaning to say that the sponsor is actually paying OUE commercial REIT and income support, and that actually helps to buffer the total so-called final distribution or final net property income of OUE commercial REIT. So you can see that even though revenue dropped by 22%, in terms of the distribution percent, it is not as severe as the total revenue drop as well, right? And there's also a release of the 5 million distribution previously retained due to the uncertainty. So when things actually become much more brighter in terms of prospect, they actually reimburse back the distributions back, and that actually helps to narrow the distribution differences between second half of 2021 and second half of 2020. Right, if you zoom into the hospitality segment performance of OUE commercial REIT, right, you can see that revenue is still flat, but due to a little bit of improvement in the overall operating expenses, the net property income actually climbed by 7.6%. It's not much, but actually there is a little bit of stability and a little bit of so-called cushion during the most toughest period for the hospitality segment of OUE commercial REIT. Overall, if you look at fiscal year 2021 and fiscal year 2020, it still remains flat in terms of the total revenue. And in terms of net property income, it also just increased by 4.1%. So from here, you can see that actually the hospitality segment actually remains quite defensive during fiscal year 2020 and 2021. It's just that the catalyst or the recovery element hasn't come to play, and you don't see a significant hike or improvement in their so-called revenue during fiscal 2021. But moving forward, with the reopening of border, of course, things are actually assumed that recovery is in play, and we do want to see some kind of recovery for the hospitality segment of OUE commercial REIT. Right, I think one of the more crucial KPIs or ratios that if you want to invest or look into hospitality REITs or trusts is that you need to also take a look at their RevPAR, which is actually revenue per available room, or RevPAR, which is revenue per available unit if it's service apartments. So you can see overall, due to the so-called local staycation demand by the so-called local residents, you can see that the RevPAR actually improved for the fourth quarter of 2021 compared against third quarter of 2021. So during the year end of last year, when things were slowly starting to lose just within Singapore, we can see that the numbers actually kicked in and showed that there is a hint of a local staycation actually contributing to hospitality's segment's recovery. But overall, if you look at fiscal year 2021 total versus 2020, there is still much room to catch, because I think for a huge part of fiscal year 2021, a lot of things will remain closed, and I think that was the period of time where the variants were very, very aggressive, and then we were just started to get vaccinated, right, which was the beginning of last year. Until the vaccination crosses a certain threshold, then only the loosening of the measures start to kick in take place, and then you see the local economic activities like shopping mall footfalls, recovery in terms of the local staycation demands actually come to support the fourth quarter results. Right, I think due to the special fact that OUE Commercial REIT is not a pure play hospitality REIT, if you really do see some kind of catalyst or prospects of it, I think there are other questions you need to ask yourself before you actually enter or actually consider OUE Commercial REIT. Because if you were to look at it later on a valuation point of view, they are actually one of the cheapest among the 5 REITs that we talk about today. Since it also has a huge contribution coming from the office buildings, the commercial REITs or portion of it, you need to ask yourself how fast, right, will not only the hospitality market recover, and how significant will the hospitality contribute and lift and increase the overall OUE Commercial REITs performances. If hotel were to run and recover smoothly beyond expectations, how much can it actually move and also drag up the so-called commercial part of it as well, right? So, and then you also need to ask that since OUE Commercial REIT divested 50% of OUE Bayfront, is it a good move for the mid to long term point of view, right? What are they going to use from the proceeds from the divestment? Is it going to be invested or paring down the so-called leverage or the debt headroom? So these are questions you need to ask. And then we also have a snapshot here, the so-called main portion of our OUE Commercial REIT, which is the office buildings inside their portfolio. You can see that in terms of the committed rents, some of it or most of it is still actually a little bit behind the comparable sub-market rents provided by the so-called independent valuators. So this has to also catch up or be in par so that the overall performance of OUE Commercial REIT can actually move in tandem with their results, right? And then last but not least, you need to ask yourself, with today's price and distribution yield, how far away are they from their historical fair valuation? So once you actually are able to answer the questions or the so-called concerns posed or available on OUE Commercial REIT, then only you can find an angle and a thesis to actually bet on commercial OUE Commercial REIT's recovery, right? So maybe I will pass it on to Yanlin. Any other aspects or questions that potential investors would want to take a look on before they actually consider OUE Commercial REIT as a potential recovery stock?
Okay, thanks, Joo Parn. Thanks. So thanks for your presentation. From your presentation, we can know that actually OUE Commercial Trust mainly operates in Singapore, and it's very diversified because no single asset accounts for more than 25%. And so far, similar to other trusts, actually the price of OUE Commercial Trust has not reached the level before the COVID. As for the divested OUE Bayfront property, actually, it's of course this Bayfront property has the high quality offering and location. It's a very good location. Actually, I do believe it will continue to enjoy strong demand in Singapore. But before we can talk about the long term, I think the short term we have to consider as well. The divestment will bring financial flexibility, and it can reduce the debt as well, and it can helpful if it wants to acquire higher yielding asset. So as we can see, actually OUE Commercial Trust now is trading at a PB ratio of 0.7. So lower compared to its competitors, which I think is quite attractive while we are waiting its earnings recovery. And another thing we need to take note is that there is a minimum rate support for its sponsor from its sponsor for its hospitality portfolio and OUE Downtown. So actually, which offer some income buffer to the COVID-19. Yeah, that's my view on the OUE Commercial Trust.
Yeah. So I think you covered it quite well and perfectly as well. So due to the so-called income support and also the so-called master lease arrangement, you can see here the 2 hotels currently owned by OUE Commercial REIT. Hence, the top line of the revenue is flat because it is actually supported or buffered by the minimum rent requirement. But moving forward, we want to see a recovery play coming into the catalyst, and it's not just from the hospitality point of view, but also from the commercial point of view as well, as we highlighted in the last slide. So you need to consider the total picture before you actually consider OUE commercial REIT as a recovery play. So moving forward, we will move into another Singapore-centric hospitality trust, which is Far East Hospitality. Right. So Far East Hospitality, if we deep dive into their portfolio, they do have 3 in-house brands, mainly Village Hotel and Residences, Oasia, Hotel Singapore, and also Quincy. Right. Total 9 hotels in Singapore, 4 service residences, and most of it, if not all, are actually in Singapore. You can see right here, their properties are actually situated, I would say, mostly in touristy areas. So Clarke Quay, Robertson Quay, where you have their village residences over there, and in the Orchard Road shopping belt, which is also a great footfall for tourists. You have the Elizabeth Hotel, Rendezvous Hotel, and Quincy over there. And another, I would say, great touristy place is also the Bugis area. Right, there's also Village Hotel Albert Court, Bugis, Village Hotel Bugis, Rendezvous Hotel Singapore, and also a northern part of Orchard. You have the Novida Medical Hub. Then you have Oasis Hotel over there. But right, if you look at the revenue trend and breakdown of Far East Hospitality Trust, even though in the latest fiscal year 2021 they didn't provide the breakdown, but you can see straight from the revenue, gross revenue, it didn't really move much from fiscal year 2020, which was the year that the pandemic actually struck. But if you compare back with fiscal year 2019, where they provided the breakdown of their revenue, you can see that the fixed rent portion actually played the significant portion in fiscal year 2020, mainly because there wasn't a variable rent and hotels and for the hotels and service residences. So this is basically the so-called variable part, the upside that commercial or hospitality trusts usually enjoy when there's a huge or increased demand in bookings, and also the so-called rental revenues from their commercial premises also got increased because of the so-called reduced portion from the variable rent factor. So you can see, if I were to just presume or assume that if the revenue part top line remains the same, I would presume that the breakdown for both the fiscal year 2021 and 2022 remains the same, and it's mainly coming from a fixed portion of the so-called rental from the master leases. But I think one good thing that you need to also take a look or consider is that if you look across Q1 of 2021 until Q4, due to the so-called recovery play happening within Singapore, you can see that the so-called RevPAR and the revenue per available unit of the service apartments actually recovered significantly after Q3, going to Q4. And if you look at the total overall revenue contribution coming from the gross revenue portion, hotels mainly contributed a fixed amount or didn't really run much because of the master lease minimum rent arrangement. But in terms of the so-called income available for distributions due to better operating expenses controlling, they actually managed to increase their distributions a bit compared to what has happened or transpired in fiscal year of 2020. Right, and if you look at the overall second half 2020 performance against 2021 performance against 2020 second half performances, you can see that there are already some kind of signs of improvement and recovery. So they actually plan to distribute 100% of their taxable income for fiscal year 2021. Hence, you can see that the income available for distribution portion is actually much more significant compared to what they actually distributed in the second half of 2020. But if you look at some of the operating matrices when it comes to analyzing hotels and also service apartments, For fiscal year 2018 and 2019, prior to the pandemic, you can see that the occupancy rate has been always around 89%. Coming into 2020 and also 2021, it is still a little bit behind the so-called pre-pandemic levels. The more significant ones would be the average daily rates. Previously, it was around 160 plus. In the latest fiscal year 2021, it actually was just 70 Sing dollars. So it's more than half drop in terms of the average daily rate. And of course, the last but not least, the revenue per available room is also still very far behind. Pre-pandemic, it was roughly 144, but as of the latest fiscal year 2021, it actually dropped to 56. So there is still some room and improvements looking from these kind of matrices that can actually spur Far East Hospitality Trust moving forward in recovery team play. The same goes to their service apartments. Right, it also exhibits some kind of similar trends. The average occupancy is a little bit still behind for the latest fiscal year compared to pre-pandemic. Average daily rate did not actually decline as much compared to the hotels. And then last but not least, the so-called revenue per available unit it also did not drop as much compared to the hotels, but it is still a little bit behind what they are actually so-called historical revenue per available unit, which they encountered pre-pandemic. So there is still a little bit room to run for both their hotels and also their service apartments looking at these matrices. So since Far East Hospitality Trust is mainly Singapore-centric kind of recovery play in terms of the tourism segment, so your questions that you should ask is how fast can Singapore hospitality market recover? We know that the borders are open. We know that everyone is itching for a vacation outside of their respective home countries. But nevertheless, the news just came out, I think, less than a few weeks back. You still need time to plan your vacation. You need to apply for leaves and what are the so-called suitable periods. When can we actually see all of this actually taking place? You should actually take a deeper look. What are the so-called key tourists coming from? If they are coming from outside of Singapore, which countries? What are their holidays like? You need to actually take a deeper look on that aspect as well, so that that can actually play into a part on when the recovery quarter results can actually take place or visualize for Far East Hospitality, and what is the price now against the historical fair valuation of Far East Hospitality Trust. Maybe I'll pass it to Yanlin. Do you think Far East Hospitality Trust is better in terms of analyzing it from a recovery play against OUE commercial rate before we move into the next one?
Thanks, Joo Parn. Thanks. Okay, I think actually compared to the OUE commercial trust, Far East Hospitality Trust is a bit more attractive because of, if we're talking about the valuation, because you know why, because now the Far East Hospitality, the PB ratio is just 0.72. Before the COVID-19, right, it trades closing toward PB of 0.8 to 0.85 level. So, and just now, because Joo Parn also talked about because the figures not that good second half year of last year, but I think it's there is a good news, because at the end of last month, Far East Hospitality Trust has complete 100 million plus divestment of Central Square to city development. I think this will drive the MVA higher, and coupled with the revaluation gains as the revenue per available room recovers, and it will also drive to narrow the PB gap. And the gearing will also drop, and this provides the headroom for future acquisitions. With the borders reopening, I think the hotel may be able to raise the rates and drive distribution per unit to near pre-COVID levels. However, this is also depends on the COVID recovery situation. If there is a slower recovery in this year, like if the COVID-19 pandemic drags down, then it could pose a major risk as well.
Yeah, I think that is an important aspect to also take note of, right?
Yeah, correct.
Okay. Yeah, I think that basically wraps up on what you need to take note of if you do see Far East Hospitality Trust as a recovery play, right? So moving on to the next one, which I think we become, I would say, moving on the REITs that in the hospitality trust, they become a little bit more, I would say, exciting because they not only derive their prospects from Singapore, but also due to the fact they have operations in multiple countries. So there are more factors that you need to take note of, right? But nevertheless, we are here to guide you through to how you actually zoom into each respective REITs and how you actually gauge their recovery play and also what are the concerns that you need to take note of. Right. So moving on to Far East Fraser's Hospitality Trust. So this is the hospitality REIT or trust that actually has multiple operations around the world. Right. They have presence in the UK, so particularly in Glasgow, Edinburgh of Scotland, and then they also have their exposure in England, mainly in London, and then they do have one property in Germany, and then they do also have one hotel in Japan, Kobe. Vaccinated Kuala Lumpur is also under them. And for Singapore, I think the most trademark property that everyone would be available, would know of would be Intercontinental Singapore. And then the rest of it will actually be coming from Australia, mainly from Sydney, Novotel, and also Melbourne as well. So total, they have 15 properties. They have a footprint in 9 key cities, right? And then it is also one of the larger hospitality REITs available on the Singapore Exchange. Right, if you look at the portfolio contribution, here you already can see a little bit of patterns. So how do you actually see some patterns? So looking at the portfolio value, right? Singapore and Australia actually play a huge part in terms of contribution of portfolio valuation, right? 36% coming from Singapore, 32% coming from Australia. But when you look into their gross revenue contribution and also their net property income contribution, Singapore actually came to only just 19% and 21% respectively. So from here, you can know that even though valuation of portfolio is actually 36%, but due to the so-called tighter measures, relatively tighter measures by Singapore when we actually went through 2021, you can see that the revenue contribution and also the net property income actually shrunk or become lesser compared to their total portfolio valuation. Australia, on and off, you also look at the next slide, how different country measures actually impact the performance of each country. Even though with 32% of portfolio valuation, in terms of gross revenue and net property income, they actually contribute to more than 40%. Right, the rest of it, in terms of UK, where the so-called measures were relatively lenient across compared to other countries, you can see that no significant drop in terms of the contribution from the NAV perspective and also the gross revenue and also net property income. So the other portions remain the same, just that Singapore, you can see that, the huge disparity when you compare the portfolio value against the revenue and net property income. So one good thing about, REITs that actually have multiple operating countries and they all have different COVID measurements. You can see that Fraser Hospitality Trust actually took the effort to highlight some of the key periods within each respective countries, which are the heightened alert situation, also the lockdown periods. You can see that countries which has a huge and tight lockdown, like Sydney and also Melbourne, the so-called matrices like your ADR, your occupancy, and also a RevPAR actually got badly impacted, but nevertheless, you can see that everything actually smoothened out. There's no significant continuous downtrend. They either are actually forming a bottom, meaning that things will not go much worse from there. And countries like London, where they actually reopen the local economic borders much faster, you can see that there is a significant uptrend and recovery trend compared to other cities and other countries. So these are the so-called insights that you can actually find when you actually drill down into each of these countries' measurements and how they actually will it affect each hospitality trust performances. Looking at the so-called larger picture or the financials, you can see that gross revenue barely dropped in terms of the top line, but in terms of the distributable income and also the distributions to staple security holders, there is a significant drop because of the Singapore portion that actually underperform against the other so-called country performances. So the Singapore portion actually helped to pull down the entire Fraser Hospitality Trust performances. And I think one key aspect to also take a look at is the key balance sheet info. So later you will get a more concise overall big picture when you compare the matrices of all 5 REITs. But just a snapshot on what is going on for Fraser's Hospitality Trust. You can see that their gearing ratio is relatively on the higher side, around 42%. The so-called interest coverage ratio is also a little bit just above 2.2%. So, but one good aspect or one good, I would say, event actually happened was that they actually announced the divestment of Sofitel Sydney Wentworth. So, based on their justifications and also their explanation, if the divestment net proceeds were used to repair the debts, the so-called aggregate leverage for Fraser Hospitality Trust can actually or will actually reduce from 42%, as we saw just now, to just 34%. And that actually gives the REIT or the trust more ample debt headroom to actually fund future acquisitions, which would be potentially much accretive to their earnings and also distributions. So for potential and interested investors who are looking at Fraser Hospitality Trust for the recovery, not just Singapore, but for their hotels in Australia, Malaysia, and also the UK as well, these are the so-called catalysts that you can bank on, and what looking, and you should also look at what are the so-called potential investments that they would be making with these additional divestment funds. Right. So it is still not a clear walk in the park for Fraser Hospitality Trust, even though that we now know that borders have been lifted for their key operating countries, Singapore and Australia. How fast can the recovery actually take place? And then the divestment of Sofitel Sydney Wentworth, is it good for the mid to long term perspective, right? And then last but not least, in terms of the valuation point of view, how far are they away from their historical fair valuation, right? I will probably ask Yanlin, now that we have Fraser Hospitality Trust coming into play, we have went through 3 hospitality trusts or sectors of which with hospitality exposures. How does Fraser Hospitality Trust come into play in terms of comparing against Far East and also OUE?
Okay, thanks, Joo Parn. Okay, so from the presentation Joo Parn just gave just now, so we can see that Fraser's mainly in Singapore and Australia, because these 2 countries accounts for more than 50% of its portfolio asset. The good thing is Singapore and Australia now is further opening the border, and apart from the Singapore and Australia, right, almost all other countries where the Frasers operates now are also opening the border or trying to open in the border. And as I think similar to the last 2 hospitality trusts, because Frasers now also trade below the book value. The PB ratio now is just 0.7, if I remember correctly. It's just 0.7 something. So it's still an attractive entry price. Just now, Joo Parn also talked about the Sofitel Sydney Wentworth, the divestment, right? So it's trade, I think, on the 10% plus premium to asset value. So actually, the Joo Parn also shared this will basically go into partial debt repayment, which will definitely lower the gearing, and it will also partially offset the loss of income from the asset. Therefore, actually, any near-term acquisitions will serve as upset. So of course the REITs still here, that is the Omicron development. So because the Omicron development may cause a longer than expected delay to the global border reopening. So as an investor, we still have to look out for the Omicron development. Yeah.
Cool. Right. So
yeah.
I think that wraps up for the third hospitality trust. We are almost halfway through. Bear with us. There are two more, which I think are relatively similar and also special compared to the three hospitality trusts that we have just covered. So moving forward, I think for those who have actually or are actually yearning to go for a vacation in the Maldives, chances are this hospitality trust property would actually be catching your eye due to the fact they have some, I would say, relatively, outstanding and eye-catching hotels in the Maldives. So the next hospitality trust that we will be talking about will be CDL Hospitality Trust. Right, similar to Frasers, they do also have multiple operating countries. They have their exposure in UK, particularly in Manchester, Cambridge. They do have one properties in Florence, Italy, one in Germany, two in Maldives, if you are actually considering going there. And they do also have exposures in Perth, Auckland, Australia, New Zealand, and then a huge portion of it is still actually coming from Singapore, right? Orchard Hotel, Grand Capton, M Hotel, Studio M, right? And W Hotel at Sentosa Cove is also under CDL's portfolio. And then they also do have two properties in Tokyo, Japan, right? So similarly, when we talk about or when we deep dive into a REIT with multiple country contribution, sometimes they'll also share with us what are the so-called breakdown of each of the portfolio valuation. You can see that due to the numbers of hotels they have in Singapore, Singapore actually made up of close to 65% of their portfolio valuation. For UK, it's 16.8%. So 8% coming from UK, 6% in Germany, 2% in Italy, and in the Oceania region, New Zealand and Australia, that contributes to around 11%. And last but not least, other Asia, Maldives and Japan both contribute to 7.5%. Right. So if you do see a prospect or a recovery play, Singapore would actually play a bigger portion of it, which we already know in terms of the latest government release. But you also need to take note of the other contributing regions as well, like Europe, Oceania, and also other parts of Asia. And if you were to look at the latest second half 2021 performances by each of the countries, you can see that Singapore remained relatively flat compared to second half of 2020. New Zealand actually showed some sort of a recovery already, but Australia, which we saw just now, similar case to Fraser Hospitality Trust, they got dragged down due to the so-called hard lockdown experienced by Australia during a period of time in 2021. In terms of UK or the European countries where recovery play actually panned out much faster, you can see that there was already a significant improvement comparing second half of 2021 against 2020. Right. And of course, I think Japan also, they were still strict for, outside travelers to enter their countries. So it was actually more of a local recovery, but I think Japan also have loosened their measures in terms of accepting tourists. They shortened the quarantine stay already. So I think overall, you can safely assume that most countries are inside CDL's operating countries have actually loosened their measures. Of course, comparing fiscal year 2021 and 2020, you can still see that some or most of the countries are still actually lagging behind, but this is all the past. What actually will pan out in the future, how fast will it pan out in the future, will actually have a definite say in the price movement and also earnings recovery of CDL Hospitality Trust. I think one good thing they also did highlight is that they actually highlighted the results since Q1 of 2020 until the latest fourth quarter of 2021. It was a little bit cyclical going through these past 2 years for CDL Hospitality Trust, but during 2021, where there were surges of Omicron variant and also a few waves of so-called surges in COVID in most countries, you can see that the opening and closing of the so-called measures in respective countries actually did pull down the recovery momentum. But coming into fourth quarter of 2021, it actually surpasses the fourth quarter achievement of 2020. So due to the fact, you can see that everything is slowly moving up and exhibiting a recovery trend. So similarly, when the REIT operates in different parts of countries, they will always come out and share with us what is the recovery play, the measures of which respective countries, and how that actually is impacting their so-called contributing countries of their operations. So you can see that Singapore, it remains relatively flat, but they actually also came out with another line which includes the W Hotel, where they actually purchased back then in the third quarter of 2020 and contributed to their so-called Singapore contribution. In terms of Australia, right, it got affected by the border restrictions, hence you can see a downtrend. But overall, if you look across everything, it's either a recovery play in terms of the UK and Europe portfolio. And for the so-called Singapore and New Zealand, yes, it did came down a bit, but things have also hit a certain bottom. It has flattened out. There's no significant downturn. And judging by the recent, border losing measures by each countries, things will surely looking to recover for the better. But then again, since this is also a trust or REIT in the hospitality segment, having huge catchment and also exposure to the Singapore and Australia hospitality segment, chances are, and questions that you might need to ask for is that how fast will that actually happen? What are the so-called best periods for tourists to actually plan their so-called staycation or vacation to Singapore and also to the respective countries that these REITs are actually operating in. Of course, in terms of valuation, it is still below their pre-pandemic high, but how far are they to their so-called historical fair valuation? Maybe I'll pass it to Yanlin. Does CDL Hospitality Trust actually comes in apple to apple in terms of comparison with Fraser Hospitality, since both actually have exposure in multiple countries?
Yeah, thanks, Joo Parn. Since actually we don't have much time left, I will just briefly say something about this CDL Hospitality Trust. Actually, we can see that CDL actually mainly operates in Singapore and Europe. By its revenue, we can see the main countries, Singapore and Europe.
Yep.
And I think in Singapore, it continues to be one of the top beneficiaries to benefit from the staycation demand, as the Singapore look locally for the holiday options. But I think another thing I want to highlight here is that if we see the expected the lodging asset class, actually this CDL has entered into a land purchase agreement and the development funding agreement to invest in a build-to-rent residential property in UK. It actually highlights the management strategy to seek resilience through the diversity and early stability post the COVID. I think with a variety demand driver compared to the hospitality assets, we can believe that actually the build-to-rent investment will add its value and complement to its portfolio. I think this is quite important.
Yeah. Right. I think we need to speed up to the last REIT and then the answer to some of the burning questions that you guys have. I just briefly check Slido. So last but not least, I think someone actually did ask about S-REIT, right? So we are going to touch about S-REIT. So S-REIT, just like the two other hospitality REITs that we have touched about, they do also have operations around the world, right? So they have 10 properties in US, 4 in UK, right? Some properties in Spain, France, Belgium, and then in terms of the so-called overall diversification in terms of operating countries, they are the most diversified, right? They do also have exposures in Vietnam, Philippines, Australia, South Korea, and also China as well. So you are looking at a different animal when you talk about S-REIT residents compared to the other REITs in the hospitality segment that we have just talked about. So how they actually portray their portfolio in terms of stability, you can see that the 47% of their so-called properties or their so-called leases with the so-called actually comes with a stable component, meaning to say that there's a fixed to minimum rent component out of the so-called 100% of their gross profit. 64% of it is stable and already minimum. So there will be a 17% of it which actually coming contributes from the so-called longer stay assets. So this also acts as a, I would say, stable component because of the longer tenure. There's also much visibility in the so-called occupancy. And last but not least, this 36% is the growth component of it, meaning to say that this 36% is actually management contracts of service residents and hotels, meaning to say that if this 36 actually do run ahead and perform, it can actually pull up the entire performance of Escort, right? So 64% stable and 36% growth. And if you look at the so-called performances of Escort, I think this is one of the, I would say, the hospitality trusts that show the brightest spots in terms of the so-called results. Second half of 2021, they actually recovered 30% in terms of year-on-year comparison against fiscal year 2020 second half. Gross profit increased by 49%, distributor income increased by 19%, EPS by 14%. And then if you look at total fiscal year 2021, they actually managed to again a 7% increase. Gross profit also showed some improvement, and the distributor income actually came in at a whopping 46% improvement, right? And compared to some of the hospitality trusts that we have shown you just now, where the recovery is a little bit cyclical, for Escort Hospitality Residence Trust, you can see that the revenue per available unit is always on a steady improving trend. So regardless of whatever loosening, tightening measures happening across, for the second quarter of 2020 until the fourth quarter of 2021, it is always on a slow climb upwards. And the latest, of course, significant increase comes from the fourth quarter of 2021, where they increased 24% against the third quarter of 2021. I think one interesting fact that you need to take note of, whether you appreciate it or you want to be a little bit more cautious, is that they actually pivoted into student accommodation and focus on a bigger exposure to US. So prior to that pivot into focusing on student accommodation, 95% of their so-called portfolio is coming from service residents and hotels. And then with that new pivot, 16% is actually going to be contributed by student accommodation and rental housing. In terms of the portfolio valuation, since a huge part of this student accommodation will be in the US, you can see that the US part will actually increase from 8% to 18%. So this is just some of the so-called breakdown of properties. They actually went on, I would say, on a big jump, and they are quite aggressive by actually going into multiple properties that are actually catered for student accommodation. So here is just a brief snapshot of it, of what they are actually going to enter into. And yeah, I think if you look at in terms of the so-called financial upline, top line, and also their distributor income, the gross profit improvement, they actually recovered or showed some resilience, and the recovery actually came into play compared to other laggards like OE Commercial REIT and also Fairest. But of course, since they are going to pivot into focusing more into student accommodation, right? So the question should be that how significant or how great will this jump into the US student accommodation actually contribute, or what kind of value will it actually bring to Escort Resident Trust? Then since it also has a huge portion of their operating geographic footprint coming from Asia Pac, so how is that Asia Pac tourism or the recovery coming into play for Escort? And last but not least, once you actually know the game plan of the recovery play, what is the so-called price to historical fair valuation for Escort Resident Trust? So we are looking at a kind of REIT that tries to morph and evolve during the pandemic against some other REITs who have chose to remain pure play and pending and waiting for Singapore recovery, right? last but not least, here you have some of the key ratio comparisons between all of the 5 REITs. So you can see that second half performance, OUE is still lagging behind in terms of revenue growth and also the total fiscal year 2021. But in terms of other the remaining 4 REITs, you can see that the second half of 2021 actually already shows some sort of recovery play. And last but not least, just to run through quickly the valuations, as what Yanlin mentioned just now, OUE, Com, and Fairest are still trading at the 0.7, around 0.7 price to book value. And of course, the more expensive ones like Fraser, CDL, and Escort, they are already trading close to 0.8 and 0.9 times their price to book value. So it really boils down to you whether you are in for a deep value play or deep value thesis, or are you looking at a yield play and a recovery growth kind of game plan to actually determine what is the actual fairest hospitality REIT to be considering into your portfolio when the tourism and the hospitality business actually fully recovers. So I think that's all. We can actually pass it to Edward to moderate the questions. I think we have taken a little bit time more than we should to actually bring to you guys these 5 hospitality trusts and REITs to consider for your upcoming recovery play.
So, Joo Parn, Yanlin, I'm afraid we actually don't really have much time, but I will. I'm looking at the 4 questions here. Okay, and there is a fair question because you've been concentrating talking about the hospitality REITs industry, and it's very specialized what you've been talking about. I think this is the one question we do need to address before we let you go. What are some of the risk considerations when you're investing in REITs, and what are the sectors that may outperform hospitality? Because in the short term, obviously, if we're opening up and people are traveling, then yes, definitely plenty of upside for hospitality. But then what may be some of the risk factors, what may outperform this particular REIT sector amongst the other REIT sectors? Joo Parn, Yanlin, I'll start Yanlin.
I think I will answer first, then later Joo Parn say anything he wants to add on. So for me, REITs, right? Everyone knows that actually REITs usually they will borrow a lot of money, means they use the leverage. So usually you will see the leverage ratio will be higher than the usual the other sectors. So that's why actually our Singapore government has the restrictions on the leverage on the REITs. So that's why when we look at the REITs, because of the leverage ratio, right? So another thing is very important is the interest rate. So like if the interest rate increase, that means the REIT demand will decrease. So for the investor to invest in REITs, I think you should look at the leverage ratio and the interest rate as well is also very important, because now we are facing the interest rate hikes. So okay, so the next question is which sector will outperform the hospitality REIT, right? So okay, so I think because the hospitality REIT really depend on the international environment. So only after the international travel are back to normal, I think the hospitality REIT will back to the new normal. So if you are looking at other REITs, I think maybe for the domestic shopping mall or office, this kind of the REITs you can try to look at them first, because they are only face for the local some REITs are only faced to the local market. So for this kind of REITs will be recover first than hospitality REIT. Yeah, Joo Parn, you see if anything you want to add on.
Just quickly on that, Yanlin. So thanks for that. So look out for the gearing ratio. Look out for the still the COVID situation. Obviously, we're all hoping that China opens up, because so many of the tourists that come here are from China. Joo Parn, anything to add to that?
I think what Yanlin has covered is basically from the so-called statements point of view. Basically, you need to check whether the REITs are adhering to the rule book set by the MAS, whether certain ratios and requirements against the regulations are in place. And if there is a trend that they are hitting, going the wrong way, what are their so-called measures in plan that they want to reduce, like for example, reduce their leverage, etc. I can offer you another out-of-book kind of observation. So since you are positive on a tourism catalyst and a recovery for hospitality, do try to also visit some of the touristy areas in Singapore, say for example, Malayan, MBS. Try to gauge whether the tourists are really back or not. So this is also what I do. Sometimes I will go for an evening run and I run to the Malayan part of Singapore. From my observations, yes, tourists are slowly coming back, but nowhere still near the pre-pandemic kind of crowd that we are experiencing. So there's also one of the kind of gauge that you can actually, take note if you are a retail investor that want to look at it from a more scatterbutt kind of perspective. Other than that, I think if you want to gauge whether other sectors REITs are actually outperforming or could outperform hospitality, I think the results are, or the so-called choices are pretty much clear. Retail REITs and also commercial REITs might actually come into play in terms of recovery much faster than hospitality REITs, because local support, local economy reopening has already helped to factor in the recovery play for retails and also commercial. But then again, there are also a lot of things happening in the Singapore REIT sector. You have consolidation of retail REITs and commercial REITs, coming together and merging together. So that actually also comes into new questions that you should ask, whether is it the right time and what is the valuation that you want to enter if you want to consider a retail and a commercial REIT hybrid to bet it to recover faster than a hospitality REIT. So it's not a closed-end question, but a very, very open-end scenario that you should actually take note of.
I love what you said, Joo Parn, because yesterday we had the OE Commercial REIT CEO on, and he was telling the story about how he takes an extra minute this week compared to the previous weeks to take the lift from the bottom floor of Singapore Hilton Orchard, used to be Mandarin Orchard,
yeah.
to the top floor. So why? Because he has to help the guests, because there's so many guests now in his hotel. So I mean, it's him talking about his hotel, sure, but nevertheless, we're seeing hotel occupancies go up, so can't be a bad thing. So unfortunately, that's all the time we have. Thank you so much, Yanlin and Joo Parn, for all your research and your insights into the hospitality sector here. We really appreciate having the two of you. Thank you.
Thank you.
Thank you, everyone.
Thank you, everyone. Bye-bye.
Thank you, Edward. Bye-bye.
Thanks, Edward.
And that is it, folks, for the Singapore Trading Festival 2022. It's been 4 days packed chock full of information, analysis, and advice that you can take to the bank. If you'd like to review any of the sessions, the recordings will be available until 10th April at www.sgtradingfestival.com. Yes, the same website you're on. You head to the main lobby, there is a recorded sessions button. Click on that. You can access any of the sessions from the previous weekend as well as this weekend. We would also greatly appreciate if you can click on the bottom right of the main lobby or on the screen. You can click on this survey form button. Please do give us your feedback so that we can do better for you next year. Let us know what you liked. Let us know what you didn't like. Let us know how we can do better. Thank you for joining us, and here's wishing all of you a safe and profitable year ahead. Goodbye, everyone.